Hey, I'm Mark. Welcome to the Doodle Economy. The market is partying right now, but everybody feels like a genius. But there's one invisible monster that could kill this party instantly. Interest rate. It's basically the final boss of the global economy. Today, I'll show you exactly why it crushes your stocks. First rule, when you see this red sign, it's not a traffic light. It's the Fed yelling, okay, fun is over. Easy money session, cancel. This is where the most people get absolutely cooked. I love my iPhone, so Apple stock must moon. Wrong. Great product doesn't mean great price. A stock isn't a lottery ticket. It's a price tag on the future cash. You pay real money today for the promise of maybe money later. Good luck. Interest rates are the gravity. The gravity is slow. Everything floats, even nonsense. When gravity rises, reality lands on your portfolio like a brick. And when the Fed pulls the lever, the market doesn't dip. It gets punched in the stomach and starts questioning its life choices. I call this the triple beatdown: profit, alternative, and the nerd math. Let's start with the punch number one. Remember 2021? Everyone was genius. Your cousin was a day trading from the couch. Why? Because money was basically free. Corporations love debt, not because they're evil, but because it's a cheat code. Borrow cheap, grow faster, look smart. It's capitalism on easy mode. Even the giants, Apple, Amazon, they borrow billions like normal grocery shopping. Why spend your own cash when banks were basically handing it out? Low rates turn debt into rocket fuel. You borrow, you expand, and you buy competitors, and everyone calls you a visionary. In 2020, rates were basically zero. It was an all-you-can-eat buffet of cheap money, and corporations went back for seconds. So they binged, borrowed billions, loaded up the truck, confidence was high, risk management was missing. They launched moonshot projects. Let's build a metaverse. Let's reinvent everything. Let's hire a VP of vibes because hey, money felt imaginary. They hire anyone with a resume and Wi-Fi. Discipline? Gone. Efficiency? Optional. It was growth at all costs. And the favorite magic trick: stock buybacks. Borrow your money, buy your own stock, make the chart look amazing, financial makeup, full glam. So the line went up, only up, and suddenly everyone thought they were Warren Buffett's. Spoiler, they were just surfing a wave. That's what bubbles do. They make dumb decisions, look brilliant, until the bubble pops, and your genius strategy turns into a lesson. Then reality wakes up. Inflation shows up like unpaid bill, X gets expensive, rent goes crazy, the Fed panics, Jerome Powell walks into the club, turns on the ugly lights, and says, "Everybody out." The free money era ended immediately. Rates jumped from 0 to 5 at warp speed. And suddenly, the mat that kept everything alive breaks. That nice cheap debt becomes expensive debt. Companies have to refinance at higher rates, and it starts eating the business from the inside. Let's say your company makes 100 millions. Sounds rich, right? Champagne vibes. But the loan resets. Instead of paying 10 million interest, now it's 60 million. Same business, new nightmare. That's not a small increase. That's profit shredder. That's your earning getting thrown into a blender. Poof, half your profit gone. Not because you forgot how to sell, but because money isn't cheap anymore. As an investor, I look at that and say, absolutely not. Why pay premium prices of half of the profit? So the investors sell, the stock drops, and the CEO suddenly stops posting motivational quotes online. You know what I mean? But now, meet the real problem. Zombies companies, businesses that don't earn money, they just exist. For years, they survive on cheap funding, new loans, new VC rounds, pre-revenue, which is fancy for we lose money professionally. No profit, just vibes, great branding, beautiful slides, and dreams that gets longer every year. They burned cash like it was firewood. As long as investor kept feeding it,
they stayed warm. But at 5% rates, investor gets picky. Funding dries up and suddenly vibes aren't accepted as payment. Laid-off begins. Free perk vanish. The office becomes quiet. Everyone learns the word profit again. The market realized maybe that dog walking app wasn't worth $2 billion. Oops. So punch one, debt gets expensive, profit shrinks, and stock prices fall back to earth. Punch two is simple. Wall Street breaks up with stocks. When rates were zero, bonds paid nothing. Bonds were basically decorative papers. So everyone bought stocks because what else? That's TINA. There's no alternative. You had to take the risk when even the price was insane. But now, safe government bonds pay around 5%. Suddenly, the boring options look real attractive. Imagine earning 5% without stress. No chart watching, no panic scrolling, just calm return. So big money asks, why gamble for maybe 8% when I can get 5% basically risk-free? So they rotate out of stocks and into bonds. Casino money goes back to the vault. Less demand for stocks means lower prices. It's not personal. It's just money being lazy. Punch 3 is nerd math. Sorry, this is the part that destroys the tech stock. $1 today is worth more than $1 in 2030 because today's dollars can earn interest. Valuation is just estimate future cash, then discount it back to today using interest rates. Higher rates shrink future money. That $1 million in 2030 suddenly looks small today. And growth stocks, they're future cash companies. Their whole pitch is trust us, we'll make money later. When rates are high, market gets impatient. I don't care about 2028. Show me profits now. The valuation resets. Boom. Stock drops, even if the company didn't change. The price changed because the math changed. Now, combine all three punches. Profits down, money leaves for bonds, and valuation shrinks. That's the perfect storm. Not a little dip, a full reset. One proof? Let's talk history in 1970s where pure inflation chaos. Paul Volcker became Fed chair and went full savage. Inflation was out of control, so he raised rates to 20%. It was brutal. Borrowing became insanely expensive. People were furious, but inflation started to break. And in the long run, it worked. Inflation came down, economy healed, pain now, stability later. And that's the lesson. When the Fed fights inflation, the squeeze spreads everywhere. Credit cards, mortgages, loans, everything gets tighter. And that is why market hates high interest rates. So here's the punchline. The Fed pulled the punch bowl and the party is over. Profit shrinks, investors bails for bonds. Valuation crash is the hangover phase. But here's the good news. No winter lasts forever. Eventually inflation breaks. The Fed chills out and the money printer warms up again. Your job, don't die. Survive this high rate brutality, so you're still standing when the next bull market starts. One last thing. I've watched people lose money in this cycle for years. Even smart people, even me. Why? Because they ignored the boring truth. Next episode, I'm sharing the boring truth I wish I knew 20 years ago. Subscribe so you don't miss the rebound. See you in episode 3.